Hey everyone, welcome back to Corporate Decoder. Today we're diving into a very interesting S-11 filing from Starwood Real Estate Income, Trust Incorporated, that is going to shed some light on a massive real estate offering. And let me tell you, the fine print here could make your eyes water or maybe just put you to sleep if we're not careful, but we'll try to make it exciting. Alright, so Starwood Real Estate Income, Trust Incorporated, or REIT Incorporated as we'll call them, is trying to raise an absolutely colossal $10 billion. That is a mind-boggling amount of money, and they're planning to do it by selling shares of their common stock. They've got 4 different classes of shares here: Class D, and Class I. The main difference between these classes comes down to fees, things like upfront selling commissions and ongoing fees that investors have to pay. Class I shares unfortunately do not have these fees, which is a big plus for investors who can get them. But don't worry, we'll break down all those fees and costs for you. This report is dated the 16th of January 2026, and it's a pre-effective amendment, meaning they are making changes and updates as they go through the process with the SEC. They're filing this with the US Securities and Exchange Commission, or SEC think of them as the ultimate referee for publicly traded companies, making sure everything is on the table and fair for investors. Now, REIT Incorporated is all about investing in real estate that brings in steady income. They're managed by an advisor company called Starwood REIT Advisors Incorporated, which is part of the bigger Starwood Capital Group. Starwood Capital is a huge player in the global investment world, especially when it comes to real estate. They've got a massive amount of assets under management and a lot of experience. But here is where it gets serious. They explicitly state up front, this investment involves a high degree of risk. They even say you should only buy these securities if you can afford to lose your entire investment. That is not something you see every day, and it is a major red flag to pay attention to. They're basically upfront about stating the risks involved, which is good. Let's quickly look at how this offering is structured financially. They've laid out the price, the commissions, and what is left for them to actually invest. With a $9.5 billion primary offering, you can see the breakdown per S-share class. For example, Class T shares will cost about $20.86 each, but a good chunk of that goes to commissions. Class I shares, on the other hand, have no upfront commissions and cost around $19.96. A big part of how these shares are priced is based on their net asset value, or NAV. This NAV is calculated monthly. They work with an independent valuation advisor to estimate the value of their properties, but it is important to remember that these are just estimates. Appraisals are subjective, and what they think a property is worth might be quite different from what they could actually get if they had to sell it quickly. This is a critical point because it directly impacts the price you pay and the price you get if you decide to sell your shares back to the company. Now, for the financials, which are always a juicy part of these filings, REIT Incorporated has actually incurred GAAP net losses in the past, meaning their accounting losses are significant. They have an accumulated deficit, which is like a hole in their finances that they've been digging, and they admit they might keep doing so in the future. This is a huge point for investors. There is no stock market where you can easily buy or sell these shares. Your only real way to cash out is to ask the company to buy them back. And they make it very clear that they are not obligated to repurchase any shares. They can choose to buy back some, none, or only a portion of what you request. On top of that, they have monthly and quarterly limits on how many shares they'll buy back. Since October 2022, actual repurchase requests have consistently exceeded these limits. This means your investment is highly illiquid. Don't count on guaranteed income. They state they cannot guarantee they will make distributions, and if they do, they might pay them using money from selling assets, borrowing money, or even from the proceeds of selling more shares. This is a big red flag because it means distributions might not be coming from actual operating profits. This ties back to the NAV. Your buy and sell prices are based on last month's valuation, not what the NAV is today. This is quite unusual and can lead to you overpaying or getting less than the shares are currently worth. They have no employees and rely entirely on their advisor, Starwood REIT Advisors Incorporated, to run the show. This creates a massive conflict of interest as the advisor gets paid handsomely by the company, and they have to allocate investment opportunities between REIT Incorporated and other funds they manage. Looking at their status, they identify themselves as a non-accelerated filer. This means they are not a large accelerated filer, which generally indicates a smaller company or one that isn't subject to as many stringent reporting requirements as the giants on Wall Street. Starwood Capital Group Holdings Incorporated is the sponsor here. This is the powerhouse company behind it all with a stellar reputation built over decades. They've raised billions and manage a huge amount of assets. They've also won a ton of industry awards, which they highlight extensively in the filing. This is a strategy to build confidence, leveraging their past successes. Their investment objectives are pretty clear: provide current income, preserve capital, achieve appreciation, and offer an investment alternative with lower volatility than publicly traded real estate companies. They invest primarily in stabilized income-oriented commercial real estate, but they also dabble in real estate debt and equity-related securities. Yes, they own quite a bit. As of the 30th of September 2025, they own 403 consolidated real estate properties valued at $20.3 billion. That is a substantial portfolio. Absolutely, they use leverage. Their target leverage ratio is between 50% and 65% of their gross real estate assets. They do have a charter limit that prevents them from borrowing more than 300% of their net assets, which is usually around 75% of the cost of their investments, but they can exceed this with approval from their independent directors. Leverage can amplify returns, but it also magnifies risk. As expected, there are a lot of risks mentioned. Some key ones include incurring GAAP net losses, limited liquidity due to no public trading market, potential inability to make distributions, NAV calculations being subjective, and a heavy reliance on the advisor. Starwood Capital, they also mention operational risks like cyber attacks. Let's look at the expenses of this offering. We're talking about almost $17 million in estimated expenses. This includes legal fees, printing, accounting costs, and even promotional items. Remember, these are costs incurred before they even start selling shares or investing the money. Their investment objectives are to provide current income, preserve capital, and realize appreciation in net asset value while offering an investment alternative with lower volatility. They are aiming for stable cash distributions. Their strategy is pretty direct: buy stabilized commercial real estate that generates income. They're looking at properties in the US and Europe, and to a lesser extent, real estate debt and equity securities. They also have a DST program. They have a distribution reinvestment plan, which is pretty common. This means you can automatically reinvest any cash distributions you receive back into buying more shares. They do automatically enroll most investors, with a few exceptions for certain states and brokerage accounts. Your transfer agent, if you need to reach out, is SSEAMP, Seagids Incorporated. Just a name to note, no real impact on the investment itself. The company's financial statements have been audited by Deloitte CDRP PDIAMP. Touch LLP. This is standard practice for public companies and means an independent auditor has reviewed their books. We've already touched on NAV, but it is crucial. They emphasize that their NAV calculation is not GAAP and it differs from book value. They rely heavily on monthly valuations, which are estimates and can lag behind real-time market changes. This subjectivity is a significant risk. The purchase and repurchase prices are generally based on the prior month's NAV, which can be a disconnect from the current market value. Looking at the historical NAV per share, you can see it's been on a general downward trend from late 2022 through early 2025. While there are monthly ups and downs, the overall trajectory is something to monitor. The company's board of directors has 10 members, with the majority being independent. This is a good sign for corporate governance, meaning they are not all beholden to Starwood Capital directly. However, Starwood Capital's chairman, Barry Sternlicht, is on their board, which is typical given their sponsor relationship. Currently, they have no employees directly working for the company. The executive officers are employees of the advisor, which is part of Starwood Capital, and they get paid by the advisor, not directly by REIT Incorporated. This is common in externally managed companies. This is a significant portion of the filing. They lay out numerous potential conflicts of interest between REIT Incorporated and Starwood Capital, the advisor, and other funds they manage. This includes the allocation of investment opportunities, the advisor's fees being tied to NAV, and the potential for Starwood Capital to benefit more from other investments or clients. They state their board of directors, including independent directors, approves transactions with affiliates, but the sheer volume of these disclosures highlights the complexity of managing these interests. It is worth reiterating the NAV calculation. It is done monthly, relying on appraisals and market data. But remember, appraisals are estimates. This section really hammers home the point that the NAV is not a perfect reflection of what you could get if you liquidated your shares. This section details how they are selling these shares. It is a best efforts offering, meaning the dealer manager will try their best but isn't obligated to sell a set amount. They're using a network of broker dealers, and there are different share classes with varying fees. The total underwriting compensation is capped at 10% of the primary offering proceeds. The fees are where it gets interesting again. Class T shares have an upfront selling commission of up to 3% and a dealer manager fee of 0.5%. Totaling 3.5%, Class S shares have up to 3.5% selling commission, and Class D shares have up to 1.5% selling commission. Class I shares have no upfront commissions. making them the most cost-effective for the investor if they qualify. These are the ongoing fees. Class T and S shares have a 0.85% annual fee, while Class D has a 0.25% fee. Class I has none. These fees are important because they chip away at your returns over time, and can even lead to your shares converting into Class I shares once the total fees paid reach a certain limit, meaning you essentially paid for the Class I shares all along. This is critical. You can ask to have your shares repurchased monthly, but as we saw earlier, it is not guaranteed. Since October 2022, repurchase requests have consistently exceeded what the company can handle. They've also reduced their monthly repurchase limits over time, making it even harder to get your money out. If you bought recently, you might face an early repurchase deduction of 5% if you try to sell back within a year. This is a dense but vital section for any investor. It details how distributions are taxed, the implications of REIT status, and the significant risks if they fail to qualify as a REIT. Failing to qualify as a REIT would mean they'd be taxed as a regular corporation, which would drastically reduce returns. The rules around what qualifies as REIT income and assets are complex and a constant balancing act. This part is for those investing retirement funds. It highlights the special rules and potential pitfalls for ERISA plans, investing in these shares, essentially warning fiduciaries to be extremely careful and consult their own advisors. Now, let's put it all together. Starwood Real Estate Income Trust Incorporated is attempting to raise a massive amount of capital, leveraging the strong reputation and extensive network of Starwood Capital. Their strategy focuses on income generating real estate, but it is not without significant risks. The limited liquidity of shares, the subjective nature of NAV calculation, and the numerous conflicts of interest with their affiliated manager are major concerns. The company has a history of net losses and an accumulated deficit, which is a worrying trend. While they own a substantial real estate portfolio, the heavily reliant advisor structure and the lack of easy resale options for investors raise questions. The fees, especially the ongoing stockholder servicing fees, can eat into returns, and the capped repurchase program is a major red flag for those expecting liquidity. The sheer scale of the offering and the company's reliance on ongoing capital raises is a significant aspect. Their strategy to diversify with real estate debt and equity securities alongside their property investments could add stability, but also complexity and new risks. Ultimately, SREIT Incorporated presents a high-risk, high-reward scenario. The potential for stable income is there, driven by a seasoned management team and a vast network, but the significant structural risks of liquidity, fee drag, and potential conflicts of interest mean investors need to be extremely cautious and understand that they are taking on considerable risk. For those who can afford to lose their entire investment and are looking for long-term, non-liquid exposure to real estate, it might align with their goals. For everyone else, it is likely best to watch from the sidelines. Alright, that is our deep dive into Starwood Real Estate Income Trust Incorporated's S-11 filing. What are your thoughts on this massive real estate offering and its associated risks? Let me know in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more corporate breakdowns. And remember, our Discord community is linked in the description below if you want to chat more about these filings and other financial topics. Thanks for watching, and we'll see you in the next one.